Hey guys, what's up? Alec back with the daily stock market, and look at that. We're up a little bit, about $200 on the day, and that's from Dogecoin. Dogecoin is up 10%. I'm recording this on Saturday, by the way, so you'll be watching this on Sunday night. I'm going to be releasing this video. It's Sunday Stock Talk, so you guys know what's in store. It's going to be 5 different stocks to have on your watch list and to be watching this week. We'll also do a quick earnings recap of some companies that are going to report earnings this week. We'll do a full video on earnings later on in the week, so make sure you smash the thumbs up on this video before it even starts. Share the video with a friend because you know they will be getting value about it. And let's go over 5 different stocks to watch this week and have on your watch list. And if you guys don't follow my Instagram yet, I post awesome stories, so make sure you turn on story notifications. And my close friends list is on my story too, so you get even better information. If you like my regular story, my close friends list is even better. So what you'll see is tech earnings start Monday. Here are 5 trends to watch. Earnings season's here. So we have IBM, Netflix, Intel, Twitter, SAP, AT&T, Seagate, Texas Instruments, and Snap all reporting earnings on June quarter results this week. Expected strength across tech landscape. Hardware and chip companies will be hampered by component shortages, so keep that in mind with EV vehicles and the chip shortages. Stay-at-home plays will likely be seeing moderate growth. It should be a strong quarter for cloud computing, online advertising, and e-commerce. And here I actually put a poll. Do you agree that all 5 mega caps will actually beat earnings? And everyone said yes. Can anything slow mega caps? I'm betting all 5 of the tech mega caps, Apple, Microsoft, Alphabet, which is Google, Amazon, and Facebook, beat estimates. Together, they're worth $9 trillion. Wow. Here's the actual earnings calendar. So we'll go over it briefly, and then we'll get into the watch list. So you see on Monday, open, you don't see too much action going on. You see kind of a bank reporting. You see AutoNation reporting. And then after close on Monday, IBM reports, which is a big one. And First Bank, some other banks. And then Tuesday, before open, you'll see Ally Bank reporting, Key Bank. Lots of banks in the earlier section of earnings. Now, after close on Tuesday, you'll see Netflix, which is a huge one. Obviously, they usually go up or down 10% when they report earnings. So that's a good thing to note if you're an option trader or a swing trader. Netflix does usually go up or down 10% when they report earnings that I've seen pretty frequently. I think they have a chance of going down. So if you're trying to play earnings, it's good to know how these stocks react in the past when they report earnings. United is another big one, United Airlines. Chipotle is Tuesday after the close. CN, we have Sleep Number. And then Wednesday before open, we have Coca-Cola, which is another huge one. We have Johnson, which is a huge one, and we have Verizon, which is a huge one. So Wednesday before open, we have a lot of dividend stocks. We have the NASDAQ. We have Harley Davidson. We have Anthem. We have Tenet, and we have Discover Financial Services. Thursday before open, we have AT&T, American Airlines, Southwest, Alaskan Airlines, which are all very, very big company. And then after close on Thursday, we have Intel, Snap, Twitter, and Del Taco and Capital One and Sam Adams and Skechers and those guys too. So we have a big earnings week coming up, and we'll kind of highlight some more in a future video, probably on Wednesday or Tuesday. We'll make another video about earnings here. Okay, so the first one we're going to be talking about is Snapchat, and it's the first one on the list, and it's reporting earnings this week is why it's on the list too. So every stock that we're talking about on the list today is going to be reporting earnings this week. So we'll hopefully see some big price movements in the stocks that are going to be discussed in today's video. So with that being said, following the support and resistance for about the last 6 months since December 2020, and you can see it's right at that $51 mark. So I think there's a strong possibility that Snapchat can go down 10% and go to that $50 or $55 price point. And once we see a sell-off happening, if we do see a sell-off happening, I think that it will go back up 10% pretty quickly and regain that loss. So there's definitely a buying opportunity there as well. We won't do too much of a deep dive today, but I thought this article was interesting. Snap put options build ahead of earnings. Snap Inc. report earnings next week, and the stock has seen a build in put option interest. The company will post earnings on Thursday. the 22nd of July, and the consensus EPS forecast for the quarter is negative 18 cents. So if they post that they're actually profitable, that could be unexpected. Snap is expected to post a rising EPS, earnings per share. If you guys want to learn more about some of these fundamental stuff like earnings, revenue, EPS, PE ratio, I have a course that teaches you everything in the most simple manner so you can be successful in the stock market, and it's very easy to understand. Snap is expected to post a rising EPS over the next 3 quarters and get closer to the profitability. So if they report profitability this quarter, that can be huge. The price of Snap currently trades at $65, and a large put option interest was seen on Friday with a January 2023 expiry and strike prices from $37 down to $32. The value of the bets would be around $600,000, but there is potential for further purchases into the earnings date. So that's already what people are buying, and he's saying that even more people can, jump on this train of the put options for Snap and go above $600,000. The company has been on track to profitability. In the last earnings report, Snap posted a revenue increase of 66%, which is huge, and an EPS growth of 10%. These headline figures are being driven by 20% year-on-year growth in daily average users, DAU. Company guidance for Q2 was estimated to be between 820 million compared to 450 million in Q2 of 2020. EBITDA was estimated to be between 20 million and break even compared to 96 million in Q2. The average revenue per user increased 36% year over year to $2.74. So look at the daily average users. People are saying Snapchat's dead and no one uses it anymore, but the daily average users are growing and the daily average revenue per user is growing also. The chart above highlights daily average users are on a fairly steady pace, and this can be extrapolated for the future growth at 20%. Overall, the price of Snap is seeing a strong move towards profitability with 20% growth in daily average users and resulting building the revenues. The headwinds for the stock is that costs are rising to create fresh content and to hold on to users, which is unlikely to see similar rate of return on average cost per user. The company is therefore relying on user numbers growing, and that cannot continue forever. Obviously, it's going to cap at some point. With this in mind, the stock seems fairly valued for a growth perspective. A recent increase in put option interest could also be an ominous sign for the shareholders ahead of the Q2 earnings report. Okay, so after Snapchat, let's talk about Verizon. And this is one that I've been picking up some shares of recently. I wanted to go closer to about $53 or $54 per share. But what I really like about Verizon is in the past 5 years, it hasn't moved much, right? In the past year, it's only moved like 0.6%. And I like that because it's a safer investment where I can put my money and I'm not fearful that it's going to lose 20, 30, 40% of my investment. This is a safe investment. It's like a money park. And the sweet thing about Verizon is they have a sweet dividend yield. Okay, so if you're a dividend investor and a safer investor, you get a 4% dividend yield. You get a 12 PE ratio on a great company like Verizon. All right, so now obviously you want to buy closer to the $47, $48 mark. I don't know if they will be going that low, but even if you can pick up to $54 or $53 per share, that's going to be a strong investment over the course of a long term. And if you're a bigger whale, for example, and you have $100,000 in your account, you typically don't want to put it into riskier investments because that $100,000 could go down to $40,000 or $60,000, and that's very painful. So if you put a large sum of your money, like $10,000 into something like Verizon, it's a safer bet and you're not going to lose a lot of your money. So it's almost more like a savings account at that point that can get some capital gains year over year. You can still get some gains on the stock, and you can also get that 4% dividend yield at the same time. Now, Verizon is expected to report earnings this week, obviously, on the 21st of July, and they beat EPS or earnings every single quarter for the last 4 quarters. You can see here the bright green dot is the actual earnings, and the dark green dot is their expected earnings. So Q2 is pretty much the same as Q1. So here you'll see dividends are all the rage as inflation crests above 5% while interest rates remain in the basement. This article assesses two of the most popular dividend stocks where investors might turn to inflation-proof on their portfolio, which is going to be AT&T and Verizon. One of them received major backlash after announcing a spinoff deal, which 50% dividend cutback, which, spoiler alert, is AT&T. Before COVID, it's hard to imagine dividend stocks would suddenly become the new momentum stock, and that's exactly what happened this spring. By May, the SPDR S&P dividend ETF, ticker symbol SDY, had gained more than twice the NASDAQ 100, 15%. After all, America had just gotten smacked with a tidal wave of inflation. It's no surprise that investors would look to boost their portfolio yield. And when it comes to your future financial health, beating inflation is arguably the even more pressing concern long term. For years, AT&T was the dividend giant among telecom giants, with yields now above 7%. That is until the company completes its spinoff with Warner Media Discover, ticker symbol DISCA, which we've talked about on this channel, next year, at which point the quarterly payout will drop nearly by half. Was this the right move for AT&T and thus its investors? Does Verizon now become the attractive alternative? And what's the bottom line on the dividend yield? Verizon will also be more of a pure play as it's offloading its own media business. Like AT&T, Verizon has two big name acquisitions under its belt, Yahoo and AOL. Now it's selling them for $4.2 billion, though retaining 10% of the media assets that regained double digits growth under Verizon's leadership, right? So you guys probably didn't know that about Verizon. Quarterly results in this sector are rarely eye-popping, but in the first quarter, Verizon turned into a modest beat on both sales and earnings, including 4.1% revenue growth, far outpacing AT&T. Now, we don't want to spend all day talking about Verizon, so the next one on the list is going to be Twitter, TWTR. And this is an interesting one that we've been talking about on the channel in the past. We were buying basically at the bottom, right around $50 to $55 per share, and we sold right around $60 to $65 per share, took some profits, and now we're looking to get back in. In my opinion, this is another one that can drop. Just like the first one we talked about on the list, Snap. I think that a put option can be considerable for this one, and I think there is a possibility that Twitter can go back down to $60 per share, making a possible opportunity to buy at $60 per share and maybe write a put option down to $60 per share, and then once it hits $60, buying some shares, so you're making money on the back end and the front end. You're making money on the put when it goes down to $60, and then you're also making money on the shares when they go up from $60 back to $66. There have been several deployments at Twitter in the last couple months. What updates to truly focus on? New revenue and monetization streams are on the way for Twitter, creating enthusiasm amongst institutional investors. The focus will continue to be whether users' growth will benefit, reducing Twitter incrementally in my portfolio to reduce risk, which I was also doing as well. As you guys heard me talk about earlier, we sold my private group. We bought at 55 or 50, between 50 and 55, and sold at $65 per share. So that was a nice little swing trade. We reduced our position. Since my last research article on Twitter, titled Twitter Can Revisit $80 per share in 12 to 18 months, Twitter has nearly rallied 25% to reclaim all its losses from previous quarterly earnings, and it's now back above $70 per share. While my postings that were stated in the low $50 range are now greatly rewarded, investors who haven't started positions in Twitter yet need to evaluate the risk more carefully at this price juncture, which I agree also. That's why I was saying that I think it can go down to $60 per share, or even the mid 50s or high $50 range. Here you'll see the latest developments. While there are always going to be many news updates for every company, I believe Twitter's share price continues to follow a specific formula used to evaluate social media companies. The primary metrics that should be used to evaluate Twitter continue to be followed data points. User growth in its US network and international network, which is, we already talked about in Snapchat also, average revenue per user, which we talked about Snapchat also, and product releases that could help energize content creators or attract more users to the network. I continue to believe that the driver of social media network stocks, that primary metric above. So here are some timelines of some recent events. Late May, Indian police raid Twitter offices due to compliance issue. Early June, Twitter launches Birdwatch to deal with misinformation. Early June, Nigeria suspends Twitter operation within the country. Early June, Twitter launches Twitter Blue, a subscription service for their content creators to monetize the following. Early June, Jack Dorsey speaks at a Bitcoin conference and discusses his enthusiasm on how he can have companies make Bitcoin accessible to everyone. Mid-June, Twitter announces the super following feature. Late June, Twitter sales chief resigns. So there is a lot going on with Twitter and stuff to be watching. What I'm doing at $70 per share, nearly 25% appreciation. The share price in less than 2 months. I have recently cut my Twitter position by 20% in my portfolio. I've actually cut it by 50 to 60% or even more, probably 75% in some of my portfolios to have more dry powder given the elevated valuation ahead of its next earning report, July 22nd. Twitter is now approximately 7% of my portfolio, and I most likely will add to any weakness after earnings report if the use basers continue demonstrating growth. Okay, I'm going to be adding to my position too, between $55 and $60 per share. I believe Twitter will continue to have more room to sustainably rally if its upcoming earning report on July 22nd surpasses positively on user growth. So it's all about user growth to pay attention to on July 22nd for Twitter earnings. While Wall Street is currently giving company benefit of the doubt with its increasing monetization streams, the most important focus continues to be on user growth metrics. As a social media equity investor, this is very important. And I hope you guys really did enjoy that video. Sorry if it turned out to be a little bit longer than expected. I didn't expect to do a deep dive into all these different stocks, but I felt like it was important to hone in on those 3 stocks specifically because I think that they can make some big movements during this earnings week. Now make sure you subscribe here on YouTube because I'll be posting earning videos just like this one all week with stocks that are going to be reporting earnings this week. So make sure you subscribe. I'll be putting out a video on Monday as well, Tuesday and Wednesday, probably all of them very similar to this one, going over different stocks reporting earnings this week. So comment below on what stock you want me to go over next that's reporting earnings this week, and I'll be happy to dive a little bit into them, give you my 2 cents on if I think they're going to be having a good earnings, if they're going to be having a bad earnings, if they're going to be going up or down. So also let me know if you like these longer deep dive videos where I only go over 3 different stocks, 3 to 5 stocks, or let me know if you like the quicker videos, the rapid fire, where I go over 5 to 10 different stocks in one video, and they're more brief explanations of what's going on. All right, guys, I'll see you in the next video. Don't forget to subscribe with notifications on. Hit that bell icon. Share this video with a friend. Comment below what stock I should be talking about next that's reporting earnings this week, and I'll see you in the next video. Remember, don't time the market, buy the market. Peace.